Good afternoon and welcome to Carr and Ingram's 2022 year-end tax planning for businesses. Today we'll spend about an hour covering different tax law changes and tax planning ideas and opportunities that you may want to consider as 2022 winds to a close. Before we get into the meat of the material, I want to cover a few housekeeping items first. If anyone is looking for CPE credit, that's continuing professional education, this webinar does count as 1 hour of CPE. In order to get that CPE, you'll need to make sure you stay logged in using your unique link for at least 50 minutes and answer at least 80% of the polling questions. If you meet those criteria, CPE certificates should be distributed via email within about 7 days after the event. And you will be getting that email from our outside vendor who manages our CPE certificates. If you have any questions about the certification process, feel free to email our marketing team. Their email address is marketing@cricpa.com. For anyone wanting a copy of the presentation slides, you can look in the webinar chat section of the Zoom platform and download those so you can have your own copy to go through and also refer back to. Now I'll introduce the presenters. First, we have Adria Darren. He is down in our Gainesville office and got her master's degree from the University of Florida. Her hobbies include watching her son play soccer and hiking around upstate New York. She has 1 beagle and 2 guinea pigs that also keep her busy. Also presenting is Addison Bailey. He is a partner in our North Carolina practice. He has his law degree from the Albany Law School, and he enjoys watching the New York Jets. He also enjoys riding motorcycles, but is proud to say that he's never had a broken bone, even with those motorcycle rides. And myself, I am Chris Hoffman. I am a partner in Nashville, Tennessee, and the tax service line leader. I received my master's degree from the University of Tennessee. In addition to watching my balls, I also enjoy watching the Titans and the Predators. My family and I travel to Hilton Head every year, and we have had Boston Terriers for as long as I can remember. So on the agenda for today, we'll kind of start out by covering a new tax law, the Inflation Reduction Act of 2022, how that may impact your business. We'll then move on into the different filing penalties relief that the IRS has offered before we go into expiring or phasing out of tax provisions, things that you may want to keep in mind that are time sensitive specific to 2022. We'll then cover the state pass-through entity tax. This is a new regime that states are using that will assist partners with avoiding the $10,000 SALT limitation. So we'll cover that in a little detail. We'll then go into PPP and employee retention credit. Those are terms very familiar to many businesses over the last few years with COVID, but we're going to still cover some areas that we may still be dealing with. We'll then move into Hurricane Ian extension items. Obviously, with Florida, then the Carolinas, both impacted by that. We'll cover that as it has broad-reaching impact. We'll then wrap up with an entity comparison, different types of items or things you need to think about as you're forming entities or thinking about forming a new entity. And then time permitting, we will wrap up with questions, but I will encourage you to go ahead and enter any questions that arise into the question and answer section of the Zoom platform. We will try and take questions as we go throughout the webinar, try and take as many as we can get to. And then, as I mentioned before, time permitting, we will address any remainder at the end. And with that, I will now hand it off to Adria, who will cover the Inflation Reduction Act of 2022.
Thanks, Chris. The Inflation Reduction Act was signed into law on August 16th of 2022. So again, this is a kind of recent new act. It has over $400 billion in climate and energy spending and tax breaks. To allow for these tax breaks, one of the revenue producers is the Corporate Alternative Minimum Tax, or AMT. This is different than kind of the historic corporate AMT tax in that it's a 15% minimum tax on adjusted financial statement income. So this is, book income. That is different than kind of in the past where it was adjusted taxable income. Book income is adjusted by bonus depreciation for tangible property, as well as net operating losses can be carried forward, but they are limited to 80% of the income. So that's similar to how taxes, the tax NOL is treated. And this could put additional pressure on companies to adjust book income because now it matters for the tax return. Now, one thing to note is that this is only going to apply to certain large corporations. So this is not going to apply to many of our clients or many of the companies probably on this webinar today. It is for companies that have over $1 billion in average book income. This is over the 3-year taxable period. And there could be exceptions to that if it's a U.S. corporation that has a foreign parent. If the U.S. corporation has more than $100 million of book income, but the whole multinational group meets that $1 billion or more average revenue, then that would make just the U.S. company liable for this corporate AMT tax. This is expected to only impact about 150 US-based companies each year. So again, this is for our very large companies within the US. It does not apply to S corporations, regulated investment companies, or REITs. So again, this is just our large C corporations, and it applies to taxable years beginning after 2022. So this is for 2023 forward, and it's estimated to raise over $220 billion over the next 10 years. So again, that's one of our revenue producers to allow for tax breaks going forward.
In addition to the corporate minimum tax, there's also another revenue raiser. It's an excise tax on stock buybacks. This will be effective January 1, 2023. It is a 1% non-deductible tax on the fair market value of stock repurchases. It's kind of broadly defined: publicly traded companies redeeming or acquiring its stock from shareholders in exchange for properties or cash. So it's with the broad-based definition, we're still waiting for regs to come out on this, but it very easily could apply to things like some M&A activities, some preferred stock or convertible stock, and maybe even some derivatives. So we're going to have to keep an eye on this. I think it could impact more companies than we originally thought when it first came out. Also, it only applies to publicly traded companies, but there is no size limitation like there is with the corporate minimum tax. So even small publicly traded companies will be subject to this excise tax. There are some exceptions to this tax going forward. The first one is if you're repurchasing stock in order to contribute it to an employer-sponsored retirement plan. So an entity buying stock to contribute to its own ESOP, that would not trigger this excise tax. There's also a de minimis, if you will, of $1 million per year. So, for example, if you have either an M&A activity or a reverse stock split where you're paying out cash in lieu of fractional shares, that $1 million will help cover that. So that would not be subject to the excise tax. And then finally, any repurchase that is treated as a dividend for tax purposes, that will not be subject to the excise tax. But even so, all told, it's expected that these provisions will raise $75 billion over the next couple of years.
And that revenue will go towards various projects. One of them is they plan on allocating over $46 billion to the IRS for tax enforcement activities. So this is to hire more enforcement agents, provide legal support, invest in additional technology to determine, who's underpaying their taxes. It is expected audit rates will increase for both individuals and businesses, but they have stated that the funding will not be used to increase audits for households or small businesses making less than $400,000. I just recently had a client who was notified that they were being audited for 2020. His gross revenue is above that $400,000, but the net profit is not. And he does have a brand new agent. So I don't know if it's part of this, expected funding or if that was already the plan before this. But that was interesting to me that it may be on gross revenue, not just the net. Other areas is the operational support. They're allocating $25 billion to that, $5 billion to business system modernization, and $3 billion to enhance taxpayer services. If you've dealt with the IRS at all in the last 2 years, it's pretty frustrating. We have clients that are still waiting on paper returns to be processed. In 2019, there was $7 million of on-process returns. And in 2021, there was 35.8 million of paper returns that had not yet been processed. So that's a significant increase in those 2 years. And I know we're still seeing additional delay in processing returns. Also, if you've ever had to call the IRS and try to get questions answered or talk to them about notices, it's pretty frustrating, to sit on hold for an hour and then have them hang up on you because they just don't have the call volume. Right now, it has the IRS is answering about 19% of the calls that they get. They're able to actually talk and help the people calling in, where it was almost 60% in previous years. So the hope is that this funding will allow for additional services to be provided to taxpayers as well.
One of the other major outlays in the Inflation Reduction Act is for expanding and extending the energy credits. A lot of these were part of President Biden's Build Back Better plan that didn't get passed. And so some of these expanded provisions have been included in the Inflation Reduction Act. For example, the 179D credits, that's your energy efficient building, that's your lighting, HVAC, building envelope, things that improve the energy efficiency of commercial buildings. Those credits have been expanded a little bit and of course have been extended. The one I wanted to spend a minute talking about is the $7,500 credit on clean energy vehicles. These are generally your plug-in hybrids. It's changed the credit a little bit. When these things first came out back in 2009, there was a maximum number of vehicles that the credit would apply to, and that was 200,000 vehicles sold in the US by a specific manufacturer. So as an example, the Toyota Prius or the Chevy Volt, those were pretty early adopters. They haven't been eligible for credits for the last few years because they had already exceeded that 200,000 sold in the US threshold. Well, beginning January 1 of 23, those limits have been removed from the 45W and the 30D credits. So those will no longer apply. So if you've looked at a hybrid vehicle before that didn't qualify, you may want to talk to your dealership because now it may actually qualify. In addition, they put some additional requirements on there regarding the materials that are in the battery. Of course, that's been a highly contested issue, is where do these high value nutrient materials come from that go into these rechargeable batteries. Also, there's a provision in there about final assembly of the vehicles has to be in North America. And that can get a little tricky because sometimes the same model vehicle, just depending on the trim level, may or may not be assembled here in the US. So again, you really need to talk to your dealership. You need to find out. This is all information that the manufacturers have to report to the IRS. So the manufacturers know about it. The dealership should know about it. But if you're ever talking to a sales rep and they don't seem to know whether or not a particular vehicle you're looking at will qualify, you can go to the IRS website and they actually have a link to a VIN decoder where you can put in the VIN of the vehicle you're looking at and determine what credits, if any, the vehicle will qualify for. In addition, I just want to mention that make sure you keep track of that VIN because that is required now in order to claim these credits on the Form 8936. So if you buy any of these plug-in hybrids or alternative energy vehicles that qualify for a credit, make sure you give your CRI tax provider that VIN number because that will be required now in order to claim the credits. One of the other pieces I wanted to mention briefly, the research and the R&D credit. That's been around for many years, but a lot of times small businesses weren't able to utilize the credit because they had losses. They were startup companies, so they never had any taxable income to offset with the credits. A few years ago, Congress expanded the use of the R&D credit and allowed small businesses to use it for payroll taxes, because obviously, even if you don't have an income tax liability, you generally will have payroll tax liabilities. And so the Inflation Reduction Act actually increased the amount from $250,000 to $500,000 a year that can be offset with the R&D credit against payroll taxes. And again, that's only for small businesses, which are defined as 5 million in gross receipts or less.
So the Inflation Reduction Act also extended the business loss limitation. This originally was put in place, this limitation was put in place for 2018. However, the CARES Act delayed that until 2021. So 2021 is the first time we have seen this business loss limitation. The Inflation Reduction Act now extends it through 2028. So originally it was until 2026, it's extended it 2 more years. For 2022, the loss that's eligible to be taken from pass-through businesses. So this is not for our C corporations, it's for S corps, partnerships. If you're a sole proprietor, you have a Schedule C. You can take up to $270,000 as a loss, or if you're a single taxpayer, or $540,000 for married filing jointly. Any additional losses in excess of that limitation amount would need to get carried forward as a net operating loss. That net operating loss would then be subject to the 80% of future taxable income limitations. So this is another kind of level of limitations. We typically have kind of the ordering rules, which for pass-throughs, you look at your tax basis first. You then have to apply at-risk rules. There's passive activity loss rules. And now, in addition to that, is this excess business loss rules, and then potentially the NOL 80% limitation. So this is just another kind of level on top of the already, loss limitation rules that we've seen in the past. I believe we are now to our first polling question.
Okay, thanks. First polling question, which of the following is true regarding the Inflation Reduction Act of 2022? Is it that corporate AMT only applies to large corporations? The excise tax on stock buybacks only applies to publicly traded stock. Additional IRS funding should not increase the number of audits in households or small businesses, or all of the above. Give everyone a few moments to respond to the first polling question. And in the meantime, wanted to remind everyone, if you're looking for a copy of this slide deck, check the webinar chat function in Zoom. And there you will find a link to download the slides. So feel free to go ahead, download the slides. You can go through them on your own machine, or have them as a reference material after the conclusion. And with that, we'll go ahead and look at the poll results. like 83% said all the above. I think that's what we were looking for, wasn't it?
It is, yes.
Okay. And now we will go into the filing penalties relief, and I think Addison is going to cover that.
Yes, thank you, Chris. The IRS earlier this year issued release number 2022-155, and that provided for some broad-based penalty relief for taxpayers affected by the COVID-19 pandemic. This applies for income tax returns filed for years 2019 and 2020. It also applies to certain foreign filing returns, banks and employers that have informational returns like 1099s. And if these forms are filed for the income returns at September 30th, 2022, as long as the returns were filed by then, you get automatic penalty relief from the failure to file penalties. Now, I do want to stress that it's only the failure to file penalties and not the late payment penalties or interest. Those still apply. But these penalty reliefs are automatic. If you've already paid a notice that assessed these penalties, the IRS will automatically issue you a refund. And the whole reason behind this is to help the IRS focus on processing their backlog returns so that they don't have to deal with issuing penalty reliefs for the failure to file penalty. Now, I do want to mention also that if you didn't file the returns by the September 30th deadline, or for example, you've got a late filing penalty for the 21 return, which wasn't covered by this notice, you still can use the reasonable cause penalty relief, the first time abatement penalty relief. There are still several tools in our toolbox that we can use to help reduce or eliminate certain penalties. So anytime you get a notice from either the IRS or a state government agency, please let your CRI representative know. There is a lot of different things that we can do to help eliminate those penalties. And with that, it's time for our second polling question.
Okay, thanks, Addison. Next polling question, true or false? You have to request a failure to file penalty relief if you file your 2020 return on September 1st of 2022. Give everyone a few moments to respond. I'll do another reminder that if you do have any questions that arise during the course of the webinar, go ahead and enter those into the Q&A section of the Zoom platform. It's during these polling questions that we typically try and answer some of the questions that have come in. And then if we have time permitting, we will answer any of the remaining ones at the end. So let's go ahead and look at those poll results. 59% say false, 41% say true. Addison, can you clarify that for folks?
Sure. The penalty abatement is automatic as long as you filed before September 30th of 22. So if you filed the 2020 return late, the penalty relief is automatic. So the answer there would be false.
Okay, thanks. Now I'm going to hand it off to Adria to cover expiring or phasing out of tax provisions.
Thanks. So the first one we'd like to cover is the business meals. So for 2021 and 2022, if you had business meals at restaurants, so again, this was in a restaurant, or it could be catering from a restaurant, the meals were 100% deductible. Though that kind of exception to the general 50% rule goes away for 2023. So those restaurant meals will now revert back to the 50% limitation for 2023. The next item is bonus depreciation. So bonus depreciation has been 100% for a few years now. This will start to phase out next year in 2023. It goes down by 20% each year. So in 2023, it'll be 80%, 2024, 60%, until finally in 2027, there will no longer be any bonus depreciation unless obviously law changes. But as of right now, so planning opportunities there. If you're planning on purchasing tangible assets, you may want to consider buying them in 2022 and still waiting until early 2023 to get that additional 20% bonus depreciation. One thing to note is there is still 179. So 179, while we won't go into necessarily the details because that's been around for many years, you can still take those 179 deductions, which could allow for full expense of those tangible or qualified real property. To go over it very briefly, there's some non-residential real property for qualified improvement properties, and they've specifically said roofs, HVAC, fire protection systems, alarm systems, and security systems all qualify. So the 179 actually encompasses potentially a little bit more than the bonus depreciation, but that is subject to dollar limitations and phase outs, as well as taxable income limitations. So if you're looking for that 179 kind of 100% expense in 2023, keep 179 in mind and see if you can take those deductions. Similar to in the past, some states don't follow 179 or don't follow bonus or have a modified 179 limitation. So those are all things to consider when you're trying to decide between bonus depreciation and 179. Again, that is not a change for 2023. Those are the same processes that you should be considering and going through. It's just that now bonus depreciation will be at 80% next year instead of that 100%. So it matters a little bit more. Another thing to consider, and again, this was for 2021, but just to keep in mind, is that bonus depreciation can create a loss, which can then convert into a net operating loss carry forward. That would be limited to the 80% the following year, where 179, while it has a limitation of taxable income for the current year, so you can't create a loss with 179, that excess 179 can be carried forward and then used next year to, as long as there's taxable income, to reduce it. So that's just a couple things to consider as you're going into 2023. And I think it is now time for another polling question.
Okay, thanks, Adria. Next polling question. Assume you purchased a piece of equipment for $10,000 on January 5th of 2023. What is the amount of bonus depreciation you can take on that equipment? Is it the full $10,000? Is it $8,000? Is it $6,000? Or is it $4,000? While people have a few moments to respond to that, we had a question come in, Adria, regarding the meals and entertainment. If a business takes a client out to, let's say, a football game, and they have food during the football game, would that food be 100% deductible in 2022, or would there be some other limitation on it?
So the 100% deduction for meals is related to restaurants. So it's specific to your restaurants. It was to encourage people to go to restaurants, which the restaurant industry was hurting. So you would have to look to see, is that food in a restaurant? Another thing to think about is entertainment. So entertainment is limited where there's no deduction for that. So you'd want to look at those entertainment rules to see if your specific fact pattern, whether meals were itemized. So you would want to look at those rules to see if it's 100% limited where you get no deduction, or potentially it could be 50% limited.
Okay, thank you. Let's look at those poll results now. 83% say there is an $8,000 bonus depreciation deduction. Adria, I think that's what we're looking for here.
Yes, that's correct. So for 2023, it would be 80% of that $10,000 equipment cost. So yes, that's correct.
Okay, thanks. And now I'm going to pass it off to Addison, who will discuss the state pass-through entity tax.
Thank you, Chris. As we mentioned earlier, several years ago, the 2017 Tax Act limited the deduction for state and local income taxes to a $10,000 maximum. So on Schedule A of itemized deductions for all 1040 taxpayers, your state and local taxes are limited to $10,000. Several years ago, some states started coming up with a way for entities, typically flow-through entities, what we would call S corps and partnerships, to pay this tax at the state level, and then they could take a full deduction for the full taxes paid because they weren't limited to that itemized deduction limit. So, for example, North Carolina in 21 passed legislation that will now take effect this year in 22, which will allow North Carolina S corps and partnerships to elect to pay tax at the state level. To give you just a quick example on how this will work, let's say, for example, you normally have a K-1 with 500,000 of income. You would file your state tax return, and if it was North Carolina, you'd pay about 25,000 in state taxes. Well, you would only get your itemized deduction limit would be capped at 10, so you wouldn't get the full benefit of that 25,000 paid to North Carolina. Under this new provision, the partnership would file and pay the tax to North Carolina, and then the K-1 you received would only have 475,000 of income instead of the 500. So you would get the full benefit of the $25,000 deduction against the K-1 income that you then report on your federal return. In addition, most states will have some sort of either a credit or an income exclusion so that the shareholder isn't also paying tax on the same income that the entity elected to pay tax on. This is, again, it's state by state, so we have to talk about each individual state's rules. There are currently 31 states that have some sort of provision similar to this, North Carolina being one of the more recent ones. Now, I don't want you to take the idea that this is a slam dunk and it should be done all the time. There are some mitigating factors we need to consider. The first one, of course, is not all partnerships or S corps have income. Some might have losses. On your personal income tax return, all those income and losses for multiple K-1s can net against each other, and you only pay tax on the net income. Well, obviously, with a state pass-through election, that's going to vary entity by entity. And so you wouldn't get that netting effect. So we really want to look at the individual owner's tax situation before we make that entity level election. So again, North Carolina, this will be the first year we're allowed to do it. We are going to be looking at it for all of our clients. We think it's going to be very beneficial to a lot of our clients, but we still need to run an analysis to make sure, because there can be other mitigating factors. The other thing I want to mention that we need to keep in mind is that this is a state-by-state option. Not all states will have this option. So if you have a partnership that files in 5 or 6 states, we may be able to make this entity level election, but we may not be able to do it on all states. So it's going to be a state-by-state analysis in addition to an entity-by-entity analysis. But overall, like I said, I can tell you, North Carolina, we're very excited about it. We think it'll be beneficial to most of our clients. And this is an election we're going to be looking at on every flow-through return that we do this year. And with that, I'm going to move it back to Chris for another polling question.
Okay, thanks, Addison. Next polling question. Should I elect to pay the optional pass-through entity tax in every state? Is it always yes? Is it never no? Or is it depends? Give everyone a few moments to reply, and then we will continue on with today's presentation. Let's go ahead and look at those results now. And Addison, it looks like everyone's been paying attention. 91% says it depends. That's what we're looking for there, isn't it?
Yes, it is. That's very true. Again, it's a state by state situation. It's also an entity by entity situation. But overall, I think it will be good for our clients.
Thanks, Addison. Now I'll pass it off to Adria to cover PPP and the employee retention credit and areas we're still dealing with those.
Yes, so we still get questions about these. I think it has been around for quite a few times, and I know probably many of you cringe when you hear it. You've dealt with it for so many years at this point. But there is a situation where the IRS has realized that taxpayers have either received forgiveness because of misrepresentation or omission of facts. They could have received the PPP when they didn't actually qualify. I know at the beginning there was a lot of questions about who qualified and what was going on, and banks seem to be just automatically giving PPP loans out. There could have been misuse of loan proceeds. So there were specific expenses you could use those funds for. And I think the IRS is realizing that maybe those funds didn't actually get used for those. And when the forgiveness application was put in, there could have been some incorrect information in that. And so what the IRS is doing is encouraging taxpayers to file amended returns to include incorrectly forgiven loan amounts as income. So part of the PPP was that, the income itself was tax exempt, but that is if it's forgiven correctly. So if you met all of the definitions, you should have received the PPP fund and you used it for the right reasons and it was forgiven, that's tax exempt income. If any of these circumstances exist where, that's not the case, they're encouraging taxpayers to file those amended returns and include it as income. That's still favorable to the taxpayer, right? You might pay some tax on it, but you're still getting the funds, the cash. There is also a form that the IRS put out to allow people to report any tax-related illegal activities related to PPP. So if you're aware of, another company that is mistreating these funds, you can report that to the IRS. The next item is the employee retention credit. So while that has stopped in Q3 2021, I am still getting questions from my clients about the ERC. They are getting emails or phone calls and voicemails from firms that are telling them, hey, we can get you a lot of money. We can file amended returns and get you a lot of money, but they don't have all the facts. So they're not looking at whether they actually meet the decline in gross receipts or any of the facts to make them eligible. They're just trying to reel that client in. So I would just encourage all clients to ask. If you're not sure if your CPA has done an analysis on whether you qualify, ask them. Very likely they could have, and they may not have brought it to your attention if you didn't qualify. They're only bringing it to you if you qualify and it's beneficial to file amended returns to get that refund. So that is out there. Just ask. I would hate for someone to get kind of sucked into that potential spam email or voicemail when you don't actually qualify. So we won't go into the details of ERC, but if you have questions about that, please let us know. And I believe we have another polling question. Yes, we do.
Okay. Thanks, Adria. Next polling question. My PPP funds were forgiven, but I didn't actually qualify for forgiveness. What should I do? Do you hope the IRS doesn't catch you? Do you pretend it never happened? Do you file an amended return to include income? Or you just give that money to charity? Give everyone a few moments to respond, and we will continue on with our presentation. Quick reminder that if you do have any questions, get those in as soon as you can so we can tackle as many as we can get to through the presentation itself. So we don't wait till the end and run out of time. Let's look at the poll results now. 96% say they are going to file an amended return to include the income. Adria, I think that's the answer we were looking for there.
Correct, that is. Yes, that is the preferential treatment, is to file that amended return and recognize income.
Okay, and then I'll hand it back to you, Adria, to cover the Hurricane Ian extension.
Yes. So for individuals and businesses anywhere in Florida, North Carolina, or South Carolina, the due date of the tax return has been extended to February 15th, 23. So this is for any returns that are due starting September 23rd. So this does include our 9/30 year ends, which typically are our trust returns, the 10/15 deadline, which was typically the extended individuals. It also applies to the 11/15 deadline, which a lot of times is the not-for-profits. Obviously, fiscal year ends will have different year or due dates. So check those if you have that situation. But all of those tax returns have been extended to February 15th of 23. This does not extend the payment of tax. So again, for our individuals who extend, the tax was due April 15th of 22. That does not get extended. So the IRS will continue to add interest and penalties from that individual 4/15 due date through the payment. So if you wait and pay in February of 23, you are going to have almost a full year of interest added to that. Another thing to note that we're making sure clients are aware is that the IRS does shut down the e-filing system sometime in December and then opens it back up at the beginning of the year. So you do want to be aware of that. We're encouraging all of our clients to go ahead and get us that information before that e-file shut down, so that we can get the returns out before we have to wait. Because with all those returns that are paper processed, they're behind. As we talked about, the IRS is way behind. And so it's much easier to go ahead and do that e-filing and get those out of the way. It does also relate to some quarterly payroll tax returns. Those can be extended. It does relate also to estimated tax payments. So for our fourth quarter individual estimated tax payments that are typically due January 15th, those have been extended to February 15th. Again, similar to the penalty abatement, these are automatically applied. So they should be able to look at the address of the taxpayer or the address of the preparer. And if it's in Florida, South Carolina, or North Carolina, this should automatically be applied. So again, you shouldn't have to request it, but if you get a notice and you believe you meet this hurricane extension and they're still assessing late filing penalties, you would want to respond to that and say, hey, I met this Hurricane Ian extension. And I believe we have another polling question.
Okay, thanks, Adria. Next polling question. Due to Hurricane Ian, the IRS has extended the due date for returns of taxpayers who reside in, is it North Carolina, South Carolina, Florida, or all of the above? Give everyone a few moments to respond. And in the meantime, had a question come in, Adria, specific to the employee retention credit. If folks are applying for that in hindsight and amending their payroll tax returns, what typical turnaround time are you seeing for the IRS to process an amended payroll tax return?
Yeah, it's kind of my experience it's been all over the map. I have gotten clients who receive their refunds pretty fast. And then I've had clients that just, I would say in the last month or two, have received 2020 refunds that were filed, right after. So it's been kind of all over the map. I don't know if, Chris, you're having a similar experience, but it kind of just depends what order those paper process returns get picked up.
Yeah, we're seeing the same here. It's been a long lag time with the IRS, typically for a lot of filings, with amended payroll tax being one of them. But you do occasionally hear of clients who get theirs processed relatively timely. And I don't know the rhyme or reason of why some go quickly and other ones don't, except I just equate it to the inefficiencies of the IRS, is the only thing I can think of.
Yeah, I agree. I haven't seen any kind of mitigating factor. It's been all over the place.
Yep. Look at those poll results now. 94% say all of the above. Adria, I think that's exactly what we're looking for there.
It absolutely is. Yes.
Okay. Now I will pass it off to Addison, who's going to cover different entity types and comparing and contrasting among those types.
Thank you, Chris. Ever since the 2017 Tax Act, which lowered the C corporate tax rate to a flat rate of 21%, we get questions from clients every year. Am I in the right entity structure? Should I change the entity structure that I currently have? And so we wanted to spend the last few minutes of this presentation just talking about the various types of entities that are out there, some of the pluses and minuses of each. With a lot of tax questions, the answer is it depends. And that really applies here because there is no one silver bullet. Each entity type has some advantages, some disadvantages. And so we really need to look at your individual fact situation and come up with what's the best entity for that particular situation. To start off with, let's talk about the 5 different types. Sole proprietorship is the first type of entity. It's a single person entity, and there's no formal requirements to set it up. If my daughter goes to the end of my driveway and opens a lemonade stand, she is now a sole proprietorship. If you have 2 or more people, you can't be a sole proprietorship, so then you become a partnership. And again, partnerships have no formal documents required in order to form them. You just have to have an agreement with 2 or more people to operate a business together. The other 3 types of entities, LLCs, S Corps, and C Corps, all are separate legal entities that require formation, typically with the Secretary of State of the state you're in. So, for example, if you want to create an LLC, there are specific documents you have to file with the North Carolina Secretary of State, and then there are annual filing requirements that you have to file in order to keep your legal entity in good standing with the state of North Carolina. Additionally, with partnerships and C Corps, there's no limit on the number of shareholders or what the type of shareholders. S Corps are the only ones that have limits. S corporations, you can only have up to 100 shareholders, and they have to be US based, that you can't have a foreign owner. Also, it generally has to be an individual or certain trusts that file an election to be an S Corp shareholder. But you can't have partnerships or LLCs or C corporations owning S Corp stock. So that is one of the drawbacks to an S Corp, is that it does have specific limitations as to who can be a shareholder.
That's right. So our next one is limited liability protection. So as Addison mentioned, LLCs, S corporations, and C corporations are separate legal entities from the owners. And so they do automatically have that limited liability protection. So if a customer is unhappy and sues the business, they can only come after those business assets. They can't go through to the owner's personal assets. Now, a sole proprietorship, because it is just that one person owner and there is no legal separation from the business and the individual, they don't have legal liability protection. So they can come after that owner's assets, individual assets. And then partnerships are kind of this in between. There's a bunch of different legal partnership types. And so it depends on what type of partnership you are, whether you have legal limited liability protection for those partners. Similarly, the next one is the tax returns itself. Because sole proprietor is just that one individual, any business income and expenses is reported on that individual's tax return. It's on Schedule C. So a lot of times you'll hear us say Schedule C, but that is part of the individual owner's return. LLCs, again, it depends if any elections are made. So if it's just a single member LLC, that would get reported just like the sole proprietorship. If there's multiple partners within that LLC, it's a partnership, and you would actually have to file a separate form. It's Form 1065. LLCs can also elect S and C Corp, like Addison said. And so you would then fall under those S Corp and C Corp, where you would file Form 1120S if you're an S corporation and Form 1120 for a C corporation. One thing to note is that the IRS just put out draft instructions for the partnership return. So for the 2023 partnership return, and in that there is a new exception for the K2, K3 reporting. So this, you hopefully have heard about K2, K3. It was additional foreign activity forms for our pass-through entities, both partnerships and S corporations. And there is now an exception for having to file those K2, K3 reporting if you meet 4 characteristics. You have no or limited foreign activity. You have all U.S. citizens or resident alien partners. The partners have to be notified 2 months in advance that they will not be getting the K2, K3 information. So that is key. So by January 15th, which is coming up faster than I think any of us would like, you would want to make sure that the partners get notified that they will not be receiving that information. And they then have a month to reply back if they need that information for their individual tax returns. If the partnership does not receive any notices back that they have partners that need that information, they now have met those new exception. Again, these are draft instructions, so we want to make sure that once they're finalized that this exception still applies, but we believe it will, and we're hoping it applies to S corps as well, although we have not seen draft instructions for the 1120S yet.
Okay, now when we talk about the income of the entity, how it's taxed is one of the main differences between the essentially the 2 different types of entities we have here. The first 4, sole proprietorship, LLC, partnership, and S corp, those are all what we call flow-through entities. So the income at the entity level flows through to the individual owners, and the individual owners pick up the income on their personal tax returns and pay the tax on that income. C corps are the only one here that are different. A C corp, again, it's a separate legal entity, but it's also a separate tax-paying entity. So a C corp pays tax on its own income, and the individual owners don't have any additional filing requirements unless money is distributed out of the C corp. So for example, one of the frustrating things about a partnership or an S corp is you have to wait for that K1 to come in every year. So, you know, if a partnership or S corp extends its return, all the owners have to extend their returns as well because they have to wait for that K1 before they file. Whereas with a C corp, for example, it could extend its return and all the owners can go ahead and file as they normally would because there's no additional filing requirement on the owners. The C corp stands on its own and files its own taxes. That can also come into play, for example, if you've got a family-owned business and you want to distribute ownership to the children. Maybe you're doing some estate planning or some business succession planning and you want ownership in the next generation of the family. Well, if it's a partnership, LLC, or S corp, all those family members are now going to be getting K1s, and now we'll have to file extensions or we'll wait for those K1s before they can file their returns. It also will require, you know, you may have to make distributions to the children owners so that they've got cash to pay tax on the income. All that goes away with a C corp. A C corp pays its own tax, and you don't have to worry about the underlying shareholders. They don't have to pay tax on anything separate unless the C corp makes a distribution. The other thing I wanted to mention real quick is that there can be some differences with income allocation. Partnerships have some flexibility, and LLCs taxed as partnerships also have flexibility as to how they allocate income, profit and loss, even how the distributions are done. Whereas with an S corp, the income has to be allocated pro rata and distributions specifically have to be distributed pro rata. Now, because the first 4 entities are flow through, all the income is taxed at the individual owner's rates, which, could be 10% or it could be 37%, anywhere along that scale. C corporations, as I mentioned previously, are taxed at a flat 21% rate. So if you've got a situation where you want to keep money in the business, if you're expanding or growing the business, you want the money to stay in there. With a C corp, you'd pay 21% and that's it. The cash stays in the business. Whereas with a sole proprietorship or a partnership or S corp, you have to pay tax on the entire income, whether or not that income is distributed out to you. So, if you're at a 37% tax rate, and then of course you might also have a net investment income tax or self-employment tax, you easily could be up over 40%. So you're going to pay 40% on that income, even though you want to keep it in the business for reinvestment. So here is definitely where a C corp can sometimes come out better, because you're only going to pay the 21% flat rate on the income.
We also get questions about whether the owner is an employee for your sole proprietorships, your LLCs, and your partnerships. Typically, you are not an owner, and in some situations like partnerships, you cannot be an employee as an owner. So those are considered kind of self-employed and self-employed income. For an S corp, you actually have to be an employee and pay a reasonable salary. That's one of the kind of rules around an S corp. And then for a C corporation, the owner can be an employee. And so what that means is that for the sole proprietorship, the LLC, and the partnership, you're paying self-employment tax. That is the 15.3% self-employment tax, which is equal to the kind of same 15.3 payroll tax that gets split between the employee and the employer for all employees. It's just on all the business income. For S corporations, you're only paying that payroll tax on the owner's salary, and the same for a C corp. It's only on that salary. So any additional business income is not subject to that self-employment or payroll tax.
Okay, and then finally, we want to talk about, well, how do you get the cash out of the entity? And here's where the flow-through entities have an advantage. With the flow-through entities, the first four on that list, you pay tax on the entire net income, so you can pull the income out tax-free at any time. You've paid the tax on the income, it's your money. C corporations are the only one that are different because they are a separate legal tax-paying entity. They pay tax on their own income, but then if you want to pull the cash out of the C corporation, it has to distribute it out to the owners through a dividend, and that then becomes taxable to the underlying shareholders. So the way you want to think about it, and this is essentially where the knock against C corporations have always been, because the C corporation pays tax on its net income, and then if it distributes the proceeds out to the shareholders, they pay tax on the dividend. When C corporations were being taxed at a 35% rate, and then you add in a 15% tax on the dividend to the shareholders, it was a much higher tax rate than the flow-through entities would typically see. But now with the C corp rate at 21%, qualifying dividends are 15%, you're at a 36% rate. Now you're actually kind of in line with what a partnership or S corp would pay if you're in the highest marginal tax rate. So again, there's no silver bullet, there's no one right answer, but certainly with the lower C corp tax rate and some of the flexibilities that C corps can have, particularly when you start talking about, you can have different classes of stock. You don't have to make distributions to shareholders to pay tax because the C corp is going to pay the tax, and it'll pay it at a lower rate if you're keeping the cash in the business. And then, of course, finally, you always want to think about, there are other ways to get cash out of a C corp. For example, if the owners are employees, you can pay year-end bonuses. We have several medical practices that are C corps, and they just zero out their income by paying bonuses to the shareholders. So again, we don't have enough time to go into detail, and we are running out of time. So I just want to say thank you for your attention and participation today. There's been a lot of great questions. We certainly will be around to answer questions, but we're out of time, so I'm going to turn it back over to Chris.
Yep. Thanks, Addison. And as Addison mentioned, we are out of time, but I encourage everyone to visit cricpa.com and find your local CRI tax professional who can answer any questions that may have been, that may have arisen during the course of this webinar. Another way you can stay up to date on tax law updates is to connect with CRI on our various social media platforms. Once you do that, you'll be able to get any of our updates that we send out on a very regular basis that will help you stay up to date with things that may impact your business. So on behalf of Adria and Addison and myself, we want to thank you for your time today, and we will wrap it up here.